Hello, everyone. This will be Chapter 4 in Managerial Accounting. This is a Cengage textbook I'm focusing on. And this week we will talk about activity-based costing. So the choice of an allocation method is important to those that are responsible in a business because that allocation method affects the product cost. Managers are concerned about the accuracy of product cost, which ultimately are used for making decisions, such as deciding what type of product mix companies will offer, figuring out the price of a product, and determining whether to possibly discontinue a product line. The most common methods of allocating factory overhead usually involve either a single plant-wide factory overhead rate or multiple production department factory overhead rates. Then there's also the activity-based costing method that we will talk about in this chapter. So here you see you're going to have a lot of factory overhead costs, and you can use a single plant-wide method, which is a lot of times much easier, but might not be as accurate as it could be. The multiple production department rate is used with companies, and then this activity-based costing method is something we're going to look at in this chapter. So here we are going to start with a question for us. This question basically asks, which of the following are considered product cost? Direct materials, direct labor, and supervisors' salaries. Direct labor, manufacturing overhead, and executive salaries. Direct materials, direct labor, and factory overhead. Direct materials, administrative overhead, and indirect labor. So we know that supervisors' salaries are part of the factory overhead. We know executive salaries are part of period costs. Administrative overhead would be part of period costs. So product costs consist of direct materials, direct labor, and factory overhead. Any cost that occurs outside of the manufacturing process is going to be a period cost. And I need to reiterate, supervisor salaries, if they are related to the factory, then that would be part of the factory overhead. Supervisor salaries, as it relates to anything with selling or administrative costs, those would be period costs. So in this scenario, when we use a single plant-wide factory overhead rate, we take the costs, all the factory overhead costs that get allocated to products, and we just use one specific type of rate. So the budgeted allocation base is a measure of operating activity in the factory. And we usually allocate them based on direct labor hours or direct machine hours or direct labor dollars. When we use a single plant-wide rate, it's really simple and it's inexpensive to figure out. However, that plant-wide single rate assumes that the factory overhead costs are consumed in the same way by all products, and we know that's just not always the case. Here we've got Ruiz Company. They manufacture snowmobiles and they manufacture riding mowers. And you see here they have budgeted factory overhead costs for the year of $1,600,000, and the direct labor hours are 20,000 hours. So here, if we created everything the same, the total budgeted direct labor hours would show with snowmobiles, they're 10 hours per unit. And with riding lawnmowers, they're also 10 hours per unit. Now, under this single plant-wide rate, the $1,600,000 gets applied to all products just using one method. Ruiz allocates factory overhead using budgeted direct labor hours as the plant-wide allocation base. So Ruiz's single plant-wide factory overhead rate, if it's $80 per hour, then we'll compute $1,600,000, divide that by 20,000 direct labor hours, gives us the $80 per, the factory overhead would be $80 per direct labor hour. Now, the effects of Ruiz Company using the single plant-wide factory overhead rate is shown on this slide here. You see that each item, the snowmobile or the riding lawnmower, is going to be charged $800 of factory overhead per unit. Which of these is the primary advantage of using a single plant-wide factory overhead rate? I think we kind of just went through this. So hopefully you'll know that the primary advantage of using this single plant-wide overhead rate is that it's simple and inexpensive to use. If we use other methods, they're going to be more expensive, but they're also going to be more accurate. Let's look at this exercise here. Tallulah's machining department incurred $1,125,000 of factory overhead costs in producing hoses and valves. The two products consumed a total of 50,000 direct machine hours. Of that amount, hoses consumed 18,000 direct machine hours. Determine the total amount of factory overhead that should be allocated to hoses using machine hours as the allocation base. So if we look here, we take the 1,125,000, divide that by 50,000 hours, and we take that figure times 18,000 machine hours for the hoses. So the amount that will be applied to hoses or allocated will be $405,000. Here we've got Platzer Instruments, makes 3 musical instruments. They make flutes and clarinets and oboes. The budgeted factory overhead cost is $1,874,400. Overheads allocated to the 3 products on direct labor hours, and the products have the following budgeted production volume and direct labor hours per unit. So you see flutes have 2 labor hours per unit, clarinets have 3, and oboes have 1.5. And here we see the volume. So we need to determine, first of all, the single plant-wide overhead rate. So we'll have to look at flutes need 15,000 direct labor hours when we take the volume times the number of hours. Clarinets need 4,500, and oboes need 1,800. So if we take that and we total the 7,500 times 2 hours for flutes is 15,000 direct labor hours. Clarinets, 4,500 direct labor hours. Oboes, 1,800. We total that, we've got direct labor hours of 21,300. So if we take the $1,874,400, divide that by the estimated direct labor hours of 21,300, we will come up with $88 per direct labor hour. Now, if we use that rate, we can figure out what will be allocated to the flutes, the clarinets, and oboes based on the direct labor hours for each of those instruments times the $88 will allow us to see the factory overhead that is being applied to each of those instruments. And then we can see if we're going to produce 7,500 flutes, that the amount of factory overhead applied per flute is going to be $176. For clarinets, we've got $264 of factory overhead applied to each clarinet, and then the oboes are $132 per oboe. Another problem for us to look at here, Cow Engines produces 3 products: pistons, valves, and cams for the heavy equipment industry. Cow Engines production process uses a single plant-wide factory overhead rate based upon direct labor hours to allocate overhead to the 3 products. So we see pistons, we see the budgeted volume and how many direct labor hours are needed per piston, 0.4. The valves, they estimate 16,000 volume, and we need 0.5 labor hours per valve. And then the cams, the 4,000, and they take 0.2 labor hours per unit. And we've got the direct materials that are needed per unit, and then the selling price per unit. So it's telling us here that the estimated direct labor rate is $25 per labor hour. Beginning and ending inventories don't matter, so we're going to say they're 0. And we expect the budgeted factory overhead to be $377,600. So the first thing we're going to do is determine the plant-wide factory overhead rate. So in order to determine this, we need to figure out how many labor hours we're estimating. If pistons, 7,500 at 0.4, that gives us 3,000 labor hours for pistons. For valves, 16,000 at 0.5, which is 8,000 labor hours. And then the cams are just 0.2, so 800 labor hours. So we total those to estimate 11,800 estimated direct labor hours. We take what we allocate, the factory overhead of $377,600, divide that by the estimated labor hours to give us $32 in overhead per direct labor hour. That's step 1. Now we need to determine the factory overhead and direct labor costs per unit for each of the products. So we know that if the pistons have 0.4 direct labor hours and the direct labor rate is $25, we can take 25 times 0.4 to give us our direct labor per unit for pistons. Our direct labor cost, 32, which is the rate we came up in the previous slide, 32 overhead per direct labor hour. We take the 32 times the 0.4, gives us the $1,280 per piston. So our direct labor is going to be 10, our factory overhead, $1,280 per piston. And up here we see that our direct materials here for pistons were $12. Okay. Valves, the same thing we're going to do. the direct labor cost $25 an hour at 0.5 gives us $12.50 per valve. The $32 of overhead times 0.5 hours gives us the 16. Here we see a valve, the direct material cost is 6, and then cams, the same thing goes. So this breaks down how we will apply per item the factory overhead per product and the labor hours. Then we've got, use this information to construct a budgeted gross profit by product line for the year. Include the gross profit as a percentage of sales. So you see here, we show the revenues for pistons. We show we're going to anticipate $7,500 at $40, gives us our $300,000 for the revenues for pistons. The direct materials, $12 times $7,500 would be the direct materials. The direct labor would be the $10 times, excuse me, am I doing that right? Pistons, $10, yes, times the 7,500 units would give us our direct labor hours. Somehow that doesn't seem right to me. Pistons, $10, 7,500, somehow that number doesn't look right to me. So I'll have to get back on that. But we see how we're getting our direct materials, our direct labor. This has probably got to be the direct labor and the factory overhead in here. So I think that's exactly, I'm skipping something because the 90 plus the 96 is only 186, and obviously I'm missing the factory overhead in this grouping here. So basically when we take our product costs here, 261 from the 300,000, we get our gross profit. So the 39,000 to the revenues of 300,000 shows we have a 13% gross profit margin. Here with the valves, the gross profit margin is 54%. And here with the cams, it's 47.7. Yeah, guys, I'm sorry. I show the direct materials and direct labor, but like a dummy, I did not add in here the factory overhead piece because we can see we're missing that line item to come up with our totals here. But no, that needed to be added, and I forgot it. But what do we learn from this? You see the valves and the cams have a pretty good gross profit percentage, 54 and 48, but the pistons have the lowest gross profit as a percent of sales, 13%. Now, it could be a lot of things. It could be that they need to find a way to make them cheaper. It could be they maybe need to be priced higher. And it's possible the factory overhead could play into this costing that might not necessarily be realistic. I don't know. But bottom line is, based on this, the pistons truly have a very low profit. So as shown here, the fabrication department incurs almost 2/3 more factory overhead than the assembly department. This is because the fabrication department has more machinery and equipment, and it uses more power. It has a lot more equipment depreciation and uses more factory supplies. So in this case, when we're using the multiple production department factory overhead, we'll use different rates for each of the production departments in order to allocate that factory overhead. So here, the fabrication department, you see, the budgeted overhead costs are $1 million, where with the assembly, they're $600,000. Now, if we take a single plant-wide rate, we use it for all the products. Whereas when we have multiple production department rates, we're going to be a lot more precise with how we apply them per product. So Ruiz company uses direct labor hours as the allocation base in the fabrication and assembly departments. The fabrication department gets budgeted for 8,000 direct labor hours, while the assembly department has a budget of 12,000 direct labor hours. So you see here, the assembly department of $600,000, divided that by the 12,000 direct labor hours will show $50 per direct labor hour. And the fabrication department, because it has $1 million in costs, allocated cost, 8,000 direct labor hours, as you see here, that overhead rate is going to be $125 per direct labor hour. So when we're talking about snowmobiles, the snowmobile is in the fabrication department for 7 hours and in the assembly department for 3 hours. Now it still has a total of 10 hours, but you can see now how by having multiple overhead rates, it might fare better. The riding mower also has 10 hours, but the fabrication department is just 1 hour, where the assembly department is 9 hours. So as you see on this slide, each snowmobile is allocated $1,025 of total factory overhead costs, but the riding lawnmowers are only allocated $575 of factory overhead cost when we handle it in this fashion. This slide shows that the fabrication department factory overhead rate of $125 per direct labor hour and the assembly department rate is $50 per direct labor hour. So since the snowmobile uses more fabrication department direct labor hours than the riding lawnmower does, the total overhead allocated to each snowmobile is about $450 greater than the amount that's allocated to each riding lawnmower. If we use the single plant-wide rate, then it's assumed all factory overhead is directly related to a single allocation rate for the whole plant. And in this scenario, it's not realistic for Ruiz, because if we use that single plant-wide rate, it really distorts the product costs then of the snowmobiles and of the riding lawnmowers. The following conditions indicate that a single plant-wide factory overhead rate can cause these distortions. Differences in production, department factory overhead rates. Some departments have high rates, some have low rates. And differences among products in the ratios of allocation-based usage within a department and then across departments. Some products have a high ratio of allocation-based usage within departments, and other products have a low ratio of allocation-based usage in the same department. Since both of these conditions are true for Ruiz, the product costs from using the single plant-wide factory overhead rates distort the true costs. So To look at this, condition 1 exists for Ruiz because the factory overhead rate for the fabrication department is $125 per direct labor hour, where the rate for the assembly department is only $50 per direct labor hour. This condition by itself won't necessarily cause a product cost distortion, but condition 2 also comes into play here for this company. The snowmobile consumes 7 direct labor hours in the fabrication department, but the riding mower consumes only 1 direct labor hour. Here's the issue. The ratio of allocation-based usage is 7-to-1 in the fabrication department. Let's look at another exercise using multiple rates. Spielman Leather Inc. produces 3 sizes of sports gloves, small, medium, and large. A glove pattern is first stenciled onto the leather in the pattern department, and then the stenciled patterns are then sent to the cut and sew department, where the glove is cut and sewed together. Spielman Leather uses the multiple production department factory overhead rate method by allocating the factory overhead with departments. Its factory overhead costs were budgeted, as we see over here on the right-hand side. The pattern department overhead is at $180,000. The cut and sew department overhead is at $756,000. Then for direct labor hours, we see in the pattern department we've got 36,000 direct labor hours, and then in the cut and sew department we have 84,000 direct labor hours. Then the direct labor hours are used to allocate the production department's overhead to the products. The direct labor hours per unit for each product for each production department were obtained from engineering records. So we have in the pattern department, small gloves take 1/4 hour, medium gloves take 35% of an hour, large gloves are 0.45 of an hour, 45% of an hour. Then the cut and sew departments, 0.4 for small gloves, 0.55 for medium, and 0.7 for large gloves. So we see them, the hours per department, and then the overhead hours. First thing we're going to do is determine the 2 production department factory overhead rates. So what we'll do is figure out the total factory overhead for each department. We've got the pattern department has $180,000, the cut and sew $756,000. We have the direct labor hours for the pattern department and for the cut and sew department. If we take the overhead, divide that by the direct labor hours, we come up with departmental overhead rates, $5 per direct labor hour for the pattern department and $9 per direct labor hour for the cut and sew department. Then determine the factory overhead per unit for each product. Here you see for the small glove, we know the small glove takes 25% direct labor hour, and we know what the direct labor hour costs are. And then we see the cut and sew department, 0.4 direct labor hours based on the overhead rate, $9 for direct labor hour. So the overhead, factory overhead for the pattern portion of a small glove is $1.25. The factory overhead for the cut and sew department for a small glove is $360. So this provides us with the factory overhead for a small glove. We'll do the same thing with the medium glove and large glove, but it's going to be different based on the amount of time needed for the medium glove and the large glove are all different. So you see here, the factory overhead for a medium glove is at $670. The factory overhead for a large glove is sitting at $8.55 per product. Let's look at this one. The management of Nova Industries, Inc. manufactures gasoline and diesel engines through 2 production departments: fabrication and assembly. Management needs accurate product cost information in order to guide product strategy. Presently, the company uses a single plant-wide factory overhead rate for allocating factory overhead to the 2 products. But management's considering the multiple production department factory overhead rate method. The following factory overhead was budgeted for Nova. So we see here the overhead for the fabrication department is $440,000. And then we've got the overhead for the assembly department is $200,000. And we show the direct labor hours that are being estimated for the fabrication and for the assembly department. So it says, in addition, the direct labor hours used to produce a unit of each product in each department were determined from engineering records as follows. So it tells us that in the fabrication department, the gasoline engine needs 6 direct labor hours. Then in the assembly department, it needs 4 direct labor hours for a total of 10 direct labor hours. But the diesel engine requires 4 hours in the fabrication department and 6 hours in the assembly department. So we need to figure out the overhead allocated to the gasoline and diesel engines under the single plant-wide factory overhead rate using direct labor hours, and then we'll determine it the per unit factory overhead allocated to gasoline and diesels using the multiple production department factory overhead rate. So using the single wide, we would take all the costs here, the 440 and the 200, the 640,000, divide that by 8,000 hours, would give us $80 per direct labor hour we would apply for both gasoline engines and diesel engines. So each engine would have 800 in overhead based on a single wide method. Now, if we use the multiple department overhead rate, then it's a little different. You see here that each department uses 4,000 direct labor hours. But in the fabrication department, we would apply $100 per direct labor hour, whereas in the assembly department, it's only $50 per direct labor hour. So that product that requires more hours in the assembly than does in the fabrication, the numbers will be skewed, because by doing a multiple overhead by department, that's going to bring these numbers down. Here you see, for the gasoline engine, since 6 hours is spent in the fabrication department and 4 in the assembly, the overhead rate for the gasoline is $860. So that's higher than what it would be if it was a plant-wide rate, a single plant-wide rate. Whereas in the diesel, there's less spent in the fabrication and more hours spent in the assembly, which brings the factory overhead rate for the diesel engine down to 740, which is lower than the single plant-wide rate. What does this tell management? Well, the multiple department overhead rate probably is more accurate. Since both have the same number of hours, then if we had a single overhead rate, everybody would get 800 per unit. But the gasoline engine consumes 6 hours of the expensive fabrication department and only 4 hours in that less expensive assembly department, where the opposite's true for the diesel engines. So in this scenario, using a single plant-wide rate really distorts the figures here. So we're going to look at activity-based costing. The activity-based costing method provides an alternative approach for allocating factory overhead that uses multiple factory overhead rates based on different activities. Activities are the types of work or actions that are involved in the manufacturing process, or this is used often for service companies. Factory overhead costs are initially budgeted for activities. Sometimes we call them activity cost pools. They can be machine usage or inspections, production setups, engineering activities. So we're going to look on the next slide at how this plays out. So assume that the following activities have been identified for producing snowmobiles and riding mowers. Fabrication, which consists of cutting metal to shape the product, which is very machine intensive. Assembly, which consists of manually assembling machine pieces into a final product, which is labor intensive. Setup, which consists of changing tooling and machines in preparation for making a new product. Each production run requires a setup. Quality control inspections, which consist of inspecting the product for conformance to specs. Inspection requires product teardown and reassembly. And then engineering changes, which can consist of processing changes in design or process specifications for a certain product. The document that initiates changing a product or process would be an engineering change order. So the cost for the fabrication and assembly activities are less than the cost shown in the preceding section, where these activities are identified as production departments. This is because the cost of setup and quality control inspections and engineering changes, which total $1 million, have now been separated into their own activity cost pools. So here you see the various activity rates are computed by the budgeted activity cost divided by that total activity base usage. The term activity base instead of allocation base is used because we're referring to activities. Activity base usage are shown here, where with snowmobiles there's 1,000 units, as there are with riding lawnmowers. We estimate 100 setups for the snowmobiles. We estimate 100 inspections and 12 change orders, whereas with the riding lawnmower, there are going to be 20 setups that are estimated, 4 quality control inspections, and 4 change orders. So you can see in this scenario, they really break it down much more specific, more detailed, and as a result are going to have more accurate numbers. But it's at a cost also. So here you see the usage, the fabrication for snowmobile direct labor hours for the riding lawnmower. You see the assembly, direct labor hours, and for the riding mower. You see the setups for each, the quality control inspections, and the engineering changes. Along with that, you can then see the cost for each activity rate. So the fabrication, we've got $45 per direct labor hour for fabrication. Assemblies, $20. The setups, if we're estimating 120 setups, it's $4,000 per setup. Inspections, we're estimating $3,000 per inspection. And then the engineering changes is $13,000 for each change order. So you see here, by doing this, the direct labor hours used by each product is 10,000 hours. We see how we show it. Snowmobiles, 7 hours in fabrication, 3 hours in assembly, where the riding lawnmower is 1 hour in fabrication and now 9 hours in assembly. Overhead cost of each activity get allocated to a product by multiplying the product's activity base, usage by the activity rate. The estimated total factory overhead for a product is the sum of the product's individual activity allocations, and the factory overhead cost per unit is computed by dividing the product's total factory overhead cost by the total units of estimated production. So here you see on this slide how we allocate the activity rate for snowmobiles for fabrication, the activity rate for the assembly on snowmobiles, the setups, the quality control inspections, and the engineering changes. We have total overhead costs, divide that by 1,000 units, gives us the cost per unit, the factory overhead cost. And then with the riding lawnmower, look at this. Do you see the factory overhead on the riding lawnmower is only $369 per unit? Because we're only using 1,000 of the fabrication direct labor hours, where we're using 9,000 of the assembly, which is only sitting at $20. Also, the setups, there are only 20 setups here for riding mowers, only 4 inspections, and 4 engineering change orders. So it clearly changes the perspective when you really take into each activity. You break it down by activity. So you see, for the snowmobile, we've got the overhead costs, and for the riding mower, we've got the overhead cost. The activity-based costing method produces different factory overhead costs per unit than the multiple department factory overhead rate method. This difference is caused by how the $1 million of setup, quality control, and engineering change activities get allocated. If Ruiz uses the activity-based costing method, its product cost would be a lot more accurate. Ruiz would have a better chance for making proper pricing decisions and using it in this fashion. If Ruiz Company used the $800 single plant-wide factory overhead cost allocation instead of the activity-based costing for pricing snowmobiles and riding lawnmowers, then the snowmobile would be underpriced because its factory overhead cost would be understated by $431. And then the riding lawnmower would be overpriced because its factory overhead cost would be overstated by $431. Let's look at another question here. Which of the following would not be considered a manufacturing activity cost pool in activity-based costing? Well, we know number of inspections or hours of machine usage or number of setups would be, but absolutely not for a number of employees in a department. Here, let's look at this exercise. This allows us to just get an understanding of how we come up with the base for activities. Isamu Foods uses activity-based costing to determine product costs. For each activity listed in the left column, match an appropriate activity base from the right column. You may use items in the activity base list more than once or not at all. So cafeteria, well, the activity base would be the number of employees that are being served. Electric power, kilowatt hours used. Human resources, number of employees. Inventory control, number of inventory transactions. Sorry, I missed this customer return processing. Wouldn't that be number of customer returns? Invoicing and collecting, number of customer orders. Machine depreciation, number of machine hours. Materials handling, number of material moves. Order shipping, number of customer orders. Payroll, number of payroll checks processed. Performance reports, number of performance reports, or production control, number of production orders. Production setup, number of setups. Purchasing, number of purchase orders. Quality control, number of inspections. And sales order processing, number of sales orders. So guys, it's pretty straightforward. It really makes sense, the order in which, or what the base is. Let's look at another one. Friedman.com Inc. sells consumer electronics over the internet. For the next period, the budgeted cost of the sales order processing activity is $875,000, and 50,000 sales orders are estimated to be processed. Determine the activity rate of the sales order processing activity, and then we'll determine the amount of sales order processing cost that would be associated with 28,750 sales orders. So if we're estimating 50,000 sales orders, we'll take the budgeted cost of $875,000, divide that by our estimated sales orders to come up with $17.50 is what we will apply per sales order. If we are wanting to know what 28,750 sales orders would show, we would just take the $17.50 times that number of sales orders to give us the cost of $503,125. Body Solid Inc. manufactures elliptical exercise machines and treadmills. The products are produced in its fabrication and assembly production departments. In addition to production activities, several other activities are required to produce the two products. These activities and their associated activity rates are shown here. So we see the fabrication we show $38 per machine hour, where assembly is $20 per machine, or by direct labor hour. We have our setups of $75 a setup, inspections $60, production scheduling $40, and purchasing would be $10 per purchase order. The activity-based usage quantities and units produced for each product are shown here. So we've got our machine hours, 500 elliptical, 700 treadmill, the direct labor hours, the setups, everything is spelled out. We need to use the activity rate and usage information to determine the total activity cost and activity cost per unit for each product. So here, if you see elliptical machines, and we see how many machine hours are needed, and then assembly, how many direct labor hours, and then the setups, inspections, scheduling, and purchasing. We do that for each, the elliptical, and then the treadmill. You see that the cost per elliptical machine would be $68.25, and the cost per treadmill is $158. Now, as we're dealing with selling and administrative expenses, they could be allocated to products for managerial decision making. One method to allocate these expenses is based on a sales volume. Products may consume activities in ways that might not be related or could be unrelated to sales volumes. And when that happens, then activity-based costing could be a more accurate method for allocating the costs. So on this slide, let's assume Abacus Company has two products, Ipso and Facto. Both products have the same total sales volume, but Ipso and Facto consume selling and administrative activities differently, as you see here. So for technical support, it looks like Facto requires some more training. The order writing, Facto requires more technical information. Same with the promotional support. Now for order entry, it looks like Facto gets purchased in small volumes, where Ipso has large volumes. Facto has a lot of customer returns, where Ipso doesn't. The Facto is shipped internationally, which involves a lot more expense and cost. And Facto, for shipping, since it's a hazardous product, there's more specialty involved in the shipping. And then the field service, again, Facto has many warranty claims. In some cases, selling and administrative expenses may be more related to customer behaviors than to differences in products. Some customers may demand more service and selling activities than other customers. In these cases, activity-based costing would allocate selling and administrative expenses to customers. Let's look at another exercise here. This one shows us Gordon Gecko Furniture Company has two major product lines. Commercial office furniture, there are few large orders little advertising support, shipments in partial truckloads, and high handling complexity. So the company produced the following profitability report for management. They show the revenues of the commercial office furniture versus the home office, the cost of goods sold, the gross profit, operating income. The selling and administrative expenses are allocated to the products on the basis of relative sales dollars. Evaluate the accuracy of this report and see if there's an alternative approach. So basically, the selling and admin shouldn't be allocated on the basis of relative sales dollars because they have very different attributes. The commercial product is inexpensive to sell. The home product has a number of additional costs that are associated with it. Because of that, allocating selling and administrative expenses using just volume, sales volume, would allocate too much selling and admin to the commercial line and too little to the home product line. The commercial product would receive twice as much selling and admin as the home product since it has double the sales. An activity-based approach could trace the selling and admin costs to the products based upon their actual consumption of activities. Such would allow the commercial product to be more profitable than it's showing right now. Okay, so now we've got Napier Inc. manufactures power equipment. Napier has two primary products, generators and air compressors. The following report was prepared by the controller. The marketing management team was concerned that the selling and admin expenses were not traced to the products. Marketing management believed that some products consume larger amounts of selling and admin expense than did other products. So to verify this, the controller was asked to prepare a complete product profitability report using activity-based costing. The controller determined that selling and admin expenses consisted of two activities, sales order processing and post-sale customer service. The controller was able to determine the activity base and activity rate for each of the activities is shown here. So we have to determine, first of all, the activity cost of each product for sales order processing and post-sale customer service activities. Here we see we've got here sales order processing. For generators, we have 3,000. For air compressors, we have 4,000. So if we take those both by $65 per sales order, we've got the activity cost of $195,000 for generators and $260,000 for air compressors. For customer service activities, we have a $200 activity rate. Generators, we're estimating 225 service requests, where the air compressors are 550 service requests. Use the information to prepare a complete product profitability report dated for the year ended December 31st. Compute the gross profit to sales and the operating income to sales percentages for each product. So we see here we've got the breakdown of generators and air compressors with our cost of goods sold. Then we have it broken down by the sales order processing and then the post-customer service. So in this case, we show the gross profit is 30% for each. But we look at the operating income as a percentage of sales. We see that the generators have a better operating income to sales of 24%, where the air compressors are at 17.67%. What does all this mean? Well, the air compressors have lower operating income to sales because the product has heavier use of the sales and service needs, activities of those departments. The air compressors are ordered in smaller quantities, so there's a higher number of sales orders. They have a high amount of after-sale service. So basically, it makes the air compressors to show a less operating income as the other product line. The generators have much less activity and thus have a higher operating income as a percent of sales. If we look at this exercise, Vetroid Electric manufactures power distribution equipment for commercial customers such as hospitals and manufacturers. Activity-based costing was used to determine customer profitability. Customer service activities were assigned to individual customers using the following assumed customer service activities base and activity rate. So we've got bid prep, shipments, support the standard items and non-standard items, and we've got the base and the activity rate. And assume that the company had the following gross profit information for 3 representative customers. So each customer shows what the revenues were, the cost of goods, and the gross profit. Now, this shows for each of the customers the activities, like the number of bid requests, number of shipments, number of standard items ordered, and non-standard items ordered. So prepare a customer profitability report dated for the year ended December 31st, showing the operating income after customer service activities. Also, the gross profit as a percent of sales and the operating income after the customer service activities as a percent of sales. So here we see that we've got our 3 customers, and then we show the cost per customer for bids, shipments, the standard and non-standard support. And from that, then, you see the operating income after the customer service activities as a percent of sales. So customer 3 looks like the gross profit looks the highest, but in fact, after the taking into account these other activities, customer 3 actually has the lower percentage of profit income from sales. Okay? Many service companies use activity-based costing. Hopewell Hospital uses activity-based costing to allocate hospital overhead to patients. Hopewell applies activity-based costing by identifying activities, determining the activity rates, and then allocating overhead costs to patients based on these activity rates. Hopewell's identified the following activities. There is admission, which is at $180 per activity, radiological testing, $320 per image. Operating room, $200 per operating room hour. Pathological testing, and then dietary and laundry. So this is how they break down the various activities. We see cost for radiological testing and what they estimate the activity base to be, 3,000 images. So if you take the 960,000, divide that by 3,000 images, that would give us $320 per radiological image. Okay. So based on those various activities, Hopewell Hospital's overhead that gets allocated to Mia Wilson was $2,790 based on 1 admission, 2 radiological testing, 4 hours in the operating room, 1 pathological testing, and 7 days in the hospital. Here you can see the patient profitability based on various activities that they took part of. You see that Aisha had revenues of $9,500, where Sergi had $21,400. Mateo had $5,050. We've got our Mia. So even though Sergi has the greater revenues, you can see there's a loss here because of all of the care that went on, and he was in the hospital for so long. So let's just look at one more exercise here. I think there might be 2, but Crosswinds Hospital plans to use activity-based costing to assign hospital indirect costs to the care of patients. The hospitals identified the following activities and activity rates for the hospital's indirect costs. So we've got room and meals, and the activity rate, $240 a day. Radiology, $215 per image. Pharmacy, $50 per physician's order. Chemistry lab, $80 per test. And operating room, $1,000 per operating room hour. We've got 2 patients, Abel and Cheryl, and we'll look at the activity costs associated with each patient and see why they're different. So again, if we look at Abel being in there for 6 days, having 4 images, 6 pharmaceutical orders, 5 tests, and 8 operating room hours, his cost here is at $11,000. Where Cheryl's, based on the number of days and the various needs, activities here, has an activity cost here of $6,025. So you can just see Abel was in there longer, had double the operating room, and everyone more radiology, more pharmacy, and chemistry. Abel obviously had a condition that required more extensive treatment. As a result, the cost is greater. Here we've got an insurance company. They carry 3 lines of insurance: auto, workers' comp, and homeowners. And they've prepared this report. Management's concerned the administrative expenses may make some of the insurance lines unprofitable. However, the administrative expenses have not been allocated to the insurance lines, so the controller suggested that the administrative expenses could be assigned to the insurance lines using activity-based costing. So we see here various activities: new policy processing, cancellation, claim audits, and claim disbursement processing. So what we'll do is complete the product profitability report through the administrative activities so we can see which of these lines are taking up some of those costs. So as you see here, as we break up these administrative activities, we see that the workers' comp has a greater operating income to the revenues than does the homeowners. So when we look at the various income, and then we take into and really show the use of these activities by the insurance line, you see that the homeowners actually has the least profitable when we look at it as a percent of premium revenues. All of them have the same percentage of underwriting income to premium revenue, but the differences show in which the way they consume those administrative activities. ABC can be used to improve the cost of a product. Lee Corporation assembles LCD monitors. The following activity information is available for the 40-inch monitor. So we have all the various activities, what we estimate the hours to be, and the rate per hour to come up with our costing. Management's looking to remove $3 of activity costs from the product in order to keep the price competitive. The activity cost reduction can be accomplished in two ways. Improve operations so that the activity-based usage per unit gets reduced or eliminated, or change the classification of employees doing an activity, which decreases the activity rate. Higher classified employees are more expensive, but they're also more skilled. So assume the process was improved so that the setup activity required 1/3 less time to complete per unit and the moving distance was cut in half. Would all this help remove the $3 of activity cost from the product? Could it be removed? In this case, as you see, the improvements are shown with the highlighted areas. The setup was reduced from 0.3 hours to 0.2 hours. The moving distance was cut from 0.4 to 0.2 hours. And those alone helped bring down the $3 target. Well, there you go, guys. I hope this has been a helpful lecture for you guys, and I'll see you next week.